Right. Okay, so then I suspect we're about to start. Hello, everyone. I honestly can't see you, but I hear we have quite a high attendance rate for this one, so looking forward to the next 60 minutes max. The topic of today's webinar is exits, the returns of startup investing and how plays involved in that and maximizing returns. I have two perfect guests to talk about this topic who will introduce themselves in a second. But before we go into it, let me sort of set the stage. So when we're talking about startup investing, we're talking about essentially venture capital. Now, venture capital or venture, so to say, is often times translated, especially in my language in German, with risk or risky endeavor. So if somebody embarks on a risky endeavor, if investors embark on a risky endeavor, they want to have some reward for that, some return. Now, there's different asset classes. Myself, having worked quite a long time in, call it traditional finance, and in less risky asset classes, the returns often come in the form of continuous dividends, like something that you yield clip over a certain amount of time. But in high risk, high reward asset classes like venture capital, the returns are more by far coming from successful exits, often called liquidity events. And there are several different ways on how these exits can happen. And this is basically the topic of today. And as I said, I'm happy that we have different perspectives on exits today, namely once through the lens of a VC fund represented by Wolfgang. And on the other hand, through the lens of a serial entrepreneur with a couple of exits under his belt, which is Radu. And that said, I would like to let my two guests introduce themselves, and we start with Wolfgang, please.
Yeah, many thanks, Ronald, and welcome to this podcast. My name is Wolfgang Neubert. I'm general partner with Apex Ventures. We are a early stage VC fund headquartered in Vienna. And we specialize in our investments in the deep tech sector. So we invest exclusively into deep tech startups in an early stage, which is mostly the seed phase or to some extent the pre-series A phase. And geographically, at that point, we are focused on the DACH region to give some geographic coordination system. Happy to be here and happy to share a little bit of our experience in that context.
Thanks so much, gentlemen. Very nice to be here with you. I'm Radu Georgescu, serial entrepreneur. Started either alone or together with co-founders. So I've been a founder or co-founder in 37 companies. SeedBlink being number 37. Out of 37, 6 were hugely successful exits. 10 didn't really lose all the money, and all the rest were amazing experiences. One may think it's a very small number, 6 successes out of 37, and I consider it could be better, but it's an amazing feature. I'm very happy with it, and all my co-founders and investors are actually very, very happy with it. I'm happy to share anything out of this experience. Ronald, we cannot hear you.
Can you hear me again now?
Yes.
Yeah.
Okay, sorry for that. Okay, so now that we have the two speakers introduced for themselves, the agenda for the next roughly 60 minutes is going to be, we'll have a lively discussion, so a preset agenda on a couple of topics we want to touch with my two guests. This will be followed by Q&A. For the Q&A, and that goes out to all attendees here, please make use of the Q&A section for your questions whenever you have them, but please be mindful that we will have sort of the second part of this hour to address those questions after we're done with our discussions. And as I said, the whole thing will last max an hour, maybe a bit shorter, depending on how lively the Q&A session will be. And without further ado, let's go into the topic of exits. And firstly, let's go into the topics of who is actually involved, which are the players at the startups table and what is the actual role in exits. There's founders, there's investors, there's board of directors. There's a whole bunch of different people and a whole bunch of different interests, sometimes aligned, sometimes less aligned, who are basically involved in exits. Radu, what's your view on this topic? What's your experience?
Yeah, no, that's a very interesting and very long to discuss, very theoretical with a lot of practical importance topic. So I'll step back a little bit and say, you know, why is this important? It's important because this is why you actually have in your term sheets, in your documentation, such and such clauses. So basically, a company can go with their its shareholders in multiple directions. And when you start a company, when you invest in a company, you don't really know, are you going to have an exit? Is it going to be a good exit or is it going to be a bad exit? Are you going to go bankrupt? Are you going to go into a long life type of dividend paying profitable company? So there are so many alternatives. So exit is, and depends on where this is going. When you invest, it's when you negotiate as a founder, or when you invest as an angel, or when you invest as a VC or whatever, you need to kind of figure out, to understand very well how an exit works, how a long-term company works, how bankruptcy works, what are the players, what are the interests, and then try to align all those cases into a document that is at least not bad for you. Ideally, that is very good for you. So exit, it's only one of the chapters of a hopefully multiple podcasts that we could arrange around this topic on what a company could, what can happen with a company and how do you prepare for that. Now, coming to this specific exit thing, there are basically three types of players in the room, right? There is the buyer. There are multiple sellers, and that's a big, important multiple thing. And there are advisors. Interestingly, the actually worst screwable up is the buyer. So that's the most risky. The buyer has the riskiest position at the table, because at the end of the day, the buyer doesn't necessarily know what they're buying, no matter how strong the due diligence is and so on. Buyer is going to be so cautious because they know they're going to, and I've read in a study, in a Harvard study, that 83% of the acquisitions end up being bad strategic acquisitions, right? So the most screwable position here is the buyer. They're going to be very cautious, very scared of what's happened, right? Then there are sellers, and multiple sellers, and this multiple is very, very easy to be treated in case of a very good exit. So everybody is doing 100 times their investment. Everybody's going to be happy. Everybody's going to be happy to share. But there are bad sales. There are fire sales when the company is selling for, you know, whatever, 10 cents a dollar or even worse. And then everybody's trying to kind of screw everybody else and get more for themselves. Now, amongst the sellers, the important categories that I see are the founder, CEO, you know, the important person or two persons of the company. The big investors, let's call them VCs, like generic, but you know, the big investors. And then together, the very early angels and the ESOP. These are slightly different to each other, but they're kind of the same. Now, the one that has to say everything, the one with the most power here is the founder. The founder has the keys of the company. And the worst thing the founder can say to a VC that wants to do something else is, okay, Mr. VC, take your company. That's your company, take it, and you know, run with it. I believe that this exit or this clause or whatever it is better. And VCs don't want to drive the company. They're not PE. They don't want to drive the company. And therefore, actually, the founders has the most power the exit process. The less power, obviously, are the early angels and the soft. And we're going to get to the power play and everything. So there are the sellers, which are the most scared, and therefore, and at the end of the day, they have the money. And you know the saying that
the buyers, yeah.
Exactly. He who has the gold, you know, rules, and the sellers and the advisors have the actual role to understand if in this Venn diagram, is there in their interest matching, is there a portion where the interest match? Now, if it's one buyer, one seller, it's kind of easy. If it's one buyer and multiple seller, it's kind of complicated. So the advisors, the investment bankers, are not only technically, you know, helping with the legalese, with the taxes, with the negotiation and everything, but they actually are the ones that are best positioned to informally, initially, understand, is there a combination where there is a middle point where everybody is everybody has a little bit of a compromise and a little bit of the interest aligned. So I think that's kind of the chairs on in my story about an exit, and we can move on and come back to more details whenever needed.
Sure. I found it interesting that you mentioned that the often sort of dubious characters of investment bankers must have having been one of those people in the past. Actually, that the third party and sort of the mediator, so to say, between making sure there's an alignment between the parties and make the sale go through. I couldn't agree more with that. And at the same time, it's also the overall overarching all of the sell side advisors to get the highest price tag possible. So to make everybody happy, because that's clear function of how he's getting paid at the end of the day. Okay, so we talked about the different players. Anything you want to add, Wolfgang, from your perspective?
Well, I think these would be the players' game. I think it's also important to understand what different forms of exits are possible. This is not a one standard procedure. But it can have a variety of different variations, options of that. I think what normally is considered as an exit is an IPO. So going public, selling the shares over a stock exchange. Yeah, if you are there, then congratulations. Then it's obviously normally a better exit than if not. But one must be honest enough that this is only the case in a very few cases, the IPO. The much more use case is the so-called trade sale, or a pure acquisition, where a company acquires the startup or acquires the one. Yeah. And here you also have to differentiate, does he acquire the whole company? So does he buy the acquirer buy 100% of the shares, or which in many cases is the case that he says, well, I would like to have the founder or the key persons stay on board as shareholders, as co-shareholders, and incentivize them by being still part of the shareholders and participating in the value increase, which means that the buyer and seller role, what Radu explained before, is a little bit blurring, because suddenly there are different kind of sellers who sell now and sellers who are going to sell later, after some period, which already creates some probably conflicts of interest. The second is, does the buyer buy with money? So does he pay for the shares, or does he pay with his shares, which is normally done when you have a merger? So in that case, the seller becomes a buyer himself because he gets shares back as proceeds, and by means of that must do his diligence of the company whose shares he's going to get in order as exit proceeds. So it's a bidirectional buying and selling process. Then it's the question of the timing. Yeah, is it as a whole buy? Is it a buy where the shares are bought, or is it just an asset deal where the acquirer buys out specific assets of the company and leaves the how the company itself alone with all tax implications? Then you have this probability of a secondary sale, which is a mini exit, I would say, where on the road specific shareholders, normally small shareholders, are bought out by a secondary. So in terms of a capital increase, some shares are also acquired for different reasons, either to simplify the cap table, to optimize the governance model, or also in order to acquire a certain percentage, which is not possible just with the capital increase alone, but where you need the buying of some specific shares in order to get the specific shareholding which you want to have at the end of the transaction. And then finally, you have a management buyout, where actually founders or specific managers buy out the investors by a buyout model. So which is also a possibility. So that's what one has to have in mind when we talk about exits. It's a broad variety of options and possibilities, and each situation is a little bit different in terms of who does what and whose interests are there in what situation.
Anything to add, Radu? I have 1 or 2 points I would linger on, but you go first.
No, I think that's absolutely perfect, because it shows how many options of where the company is going to go in the future. And it falls back at the end of the day to when you're a founder, and as well when you invest in a company, you have to look not only, do I believe that the founders are good, the company is good, the market is well, and so on, but to actually understand your position in the full deal, in the future potential deals like this, like that, like this, like that, and to actually be able to try to position, to get a position that you are comfortable in. But before, you need to really understand what position you could be in. And then if you get into that position, are you going to be in the driver's position? Are you going to be in the co-pilot position? Or are you going to be in the back of the bus and just kind of ride on with the company as with everybody else, right? So I think it's very interesting to see all the options and to understand where life could get you.
Yeah, I found it interesting that you mentioned two points I would like to comment on as well. But the first one, obviously, is the holy grail of startup investing. Everybody's talking about the shiny IPO stories, but let's be quite clear. Those are the exceptions rather than the rule. However, once they happen, besides the monetary effect of the people who work for the company, talking about ESOP holders, like Radu mentioned before, it can have a massive impact and can make a lot of people happy, and also has a very strong psychological impact for the ecosystem. Now, we are SeedBlink, our Romanian company, and every Romanian now dialing in knows what the UiPath success story meant for the country and for the ecosystem. But you have the shiny stories all the while, with NVIDIA making 70% of its workforce, turning them into millionaires, right? Meta, Google doing the same a couple of years ago. So it's very interesting, very shiny story. But again, exception rather than the rule, which brings me to my second point, which I believe as sort of an angel investor, small, medium, or even bigger angel. The secondary sale option, so a liquidity event before an actual sale, before an actual IPO, is actually quite a viable exit route that is often overlooked. So the idea that you, as the first-time pre-seed or seed investor with a small ticket, will sit on the cap table up until the company is sold, I think it's also more the exception than the rule. What is more likely to happen is that once the company progresses through the phases, Series A, B, C, you name it, there will come a certain point where the offer gets too attractive not to take it. And these, you will never read in the news about it. People might tell you in private, but this is not the public event, but you might have made a splendid return halfway through. And that's something that needs to be borne in mind, because we are talking about an asset class which is inherently illiquid. That's a characteristic of this asset class, but there is more liquidity events that people might think of. Okay.
And actually, exactly what Ron said, that's the time window where even small business angels in a cap table could play a more active or a more decisive role. In a large exit, you are sitting, as Radu said, in the last row of the bus. Yeah, so you can just watch what the guys in the front are doing. Yeah, but if it depends on you, if your 0.5% or 0.3% points are the ones which are important for the investor stepping in order to get his shareholding or to get a specific voting threshold, 25% majority or a 50% majority, then suddenly this very small share becomes powerful because it makes the difference. Yeah, and that's where one should not become too greedy, of course, in that situation, because if one plays not intelligently in that context, you could also destroy deals. Yeah, but you could, if you do it smart, also bring it in a form that you are well compensated for the early risk you take as a business angel, and get a very fair compensation, a very fair return. And here I'll talk about double-digit multiples at the end of the day.
No, and I'm gonna. I remember what you were saying a couple of days ago when we met pre this podcast. You're saying, and rightly so, at the end of the day, very small investors are coming with very small percentages. I mean, you have a few shares or even a few hundred shares or whatever, but you may have, 0.1% of the company or 0.2% of the company or whatever, and then you cannot really be having a say. And the option here is to actually pool such investors into a syndicate and actually have one voice. So instead of being, yourself with 0.1% of the company, to have 100 of us having one voice and therefore,
Absolutely.
1 or 2 or 3.
Absolutely. This helps a lot. It's bundling voting power and bundling interest. And this, of course, makes a lot of sense. Yeah, it's easier. At the end of the day, it's also much easier for the acquirer to negotiate with, because what the nightmare of all acquirers is that he has a large seller group, what you said before, Radu. Yeah, with
and one doesn't want.
And yeah, or it takes time until everybody is on the same page, and one is against, and the other is one is not available because he's on vacation. And it's not really clear if there is an anonymous desire of really selling the company. Yeah. So there might be some who says, well, I do not want to sell, but I'm dragged. Yeah. So they will be more passive in the whole story. Others who say I must sell or I want to sell will be becoming more active. And these inhomogeneous seller structures are for an acquirer a nightmare. So that's why we recommend in all situations, in order to make it more homogeneous, that one assigns some spokesperson or some deal captain, who is empowered to take the lead, to drive the negotiations in the best interest of everybody, who has to, of course, continuously to report back where he is, but in the negotiation. But please do not try that everybody wants to be at the negotiation table, because this becomes a mess, and this is one of the number one reasons why acquirers are running away. Yeah, because you say this is.
And they
never
may
get a deal. Yeah,
exactly. They may just disappear, or you may get a huge haircut. Or on the positive side, if you structure this nicely, you may actually get a bonus because the deal is softer.
Absolutely.
Yeah.
Okay, great. Brings us right to our next topic, which is when you're talking about managing expectations. I already lingered on that point a bit. So when do you actually have a say, and when don't you have a say? Now, from an investor's perspective, I think, Wolfgang, starting with you and taking the when you have a say at the table kind of angle.
Well, first I want to mention that even business angels might have a say or might have an influence. This is specifically when we talk about real business angels. So business angels, as a matter of fact, these are two words. There is the business aspect and there is the angel aspect. and the angel has everything to do with support. So the privilege what business angels to some extent might have if they play their role well is that they have a personal relationship to the founders. They have a trust relationship because they help them in a very early phase, or because they have really high social skills or have a good I would say a good discussion culture with the founders. So in that context, a business angel could be some kind of trustee of the founder in this very critical and difficult and stressful exit process. And having such a relationship may help in order to influence the whole story a little bit into his or her direction. So far about have a say. Concerning the investors, one must also be fair. I think we are an early stage investor. We see who is stepping in the seed phase. So we normally are also not the majority shareholders as an exit, because after us are then the growth investors coming in, and after that the private equity investors, if we still keep it on the financial investor side, or even a strategic investor who stepped in for strategic reasons. Yeah. And there the say or the power shifts a bit to those parties, and we as a smaller early stage VC investor also don't have a huge say. So it's a chain where the longer you are in fundraising process, the more investors come to the cap table. Of course, the more different of the power balances of the says in exits are. Yeah.
If I may ask, jump in and ask Wolfgang, it kind of seems, and correct me if I mean, is it correct or not? It seems that, the very early people, the founder and the first angels, which are really kind of helping, have power. Then the late investors have a different type of a power. This has the business power. These guys have the,
money power,
number of shares, power. And the biggest, the most screwed up are the first VC, basically, in your position. And that's like the theoretical. And is this like this? And if so, are there any tools that you are using? Is it kind of, let's get out in 1 or 2 rounds, or do you have any keys to kind of make sure that you have a little bit more power than the obvious one, or how does this work?
Well, on first hand, we do have influence in who is coming to the cap table. And we are also, we have, at least ideally, a selection power, what growth investor we accept coming to the party, or what private equity fund. And you normally do this with parties where you also have trust into, because you already had a successful exit together or know each other. So that's, in that case, we're not totally without any influence. Second, we do know the company very well, and normally in our case, because we are strong company builders, also have a very strong relationship to the founders, and to some extent we can become real founder advocates here based on the experience which we have. So whereas for a business angel, it's more on a personal relationship base or a specific business expertise, from an industrial angle. We have the experience of financial architecture and how these funds look like. So based on this experience, based on this competence, we also play a stronger influence towards the founders and towards driving the process. And third, I have to say, of course, due to our time spans, we normally also cannot wait until the real exit, the large exit, or the final exit. We already have to jump off in the secondary before. Our fund lifetime is 10, runtime is 10 years. So consider, and specifically in deep tech, we know that the cycles are longer. It's not that you buy a company or you get into a company and 2 years later have the exit. This is a very, very rare exception. But we have to wait 5, 6, 7, 8 years. Means that those companies which we invest in our 5th year of the fund lifetime we only have 5 years left.
Yeah.
So we are forced to exit, and that's why we then go more towards a secondary deal, where again we have a little bit of power, yeah, and where this one has also to take into account there is also a specific secondary market. So there are specific investors who are just specializing in making secondary deals, because they say we are going to buy a secondary share with some discount, and believe in the company, or do this even in a bundle, so not only buy one but buy a portfolio, and with the remaining time until the exit, we make our multiple. Yeah, and as the fact is that we can analyze these secondaries quite well, because we know, in difference to us, we buy a black box when we step into a company, or we invest into a black box. The secondary investor already can do a very deep diligence and can really evaluate all of the secondary deals, and then he puts his discount on that. Yeah, and that's also a relationship where one is not that powerless, but also are a strong partner on the deal table. Yeah.
Yeah.
It's an interesting point that you mentioned, because as you see, if you look at statistics, like the time to exit, just not only in deep tech, but across the VC scene, it just has increased, right? What used to be 5 to 8 years is now, I don't know, 6 to 11, whatever. So, and concurrently, it always starts in the US and then flips over to Europe. What you see is a rise of secondary funds. And that's what you were mentioning. And it just makes inherent sense, because you don't want to be in a situation where you just have to fire sale your portfolio. Yeah. And I think for me, it's also a bit of a sign of the market. Here in Austria, we have Speed Invest as the big fund with $1 billion of assets under management. And they recently established, speaking quite openly about it, like their own dedicated M&A team, because they realized the boom years are over. We have to get some liquidity back to our LPs. So this is kind of interesting to see that they are now thinking more sort of from an M&A perspective as well, and not just, hyper growth at all costs. Okay.
Yeah.
Brings me to our last agenda point, and honestly, my favorite one, and that is personal example of exits, the good ones and the bad ones, maybe even the ugly ones. So let's divide it into 2 parts. Happy exits first, because we want to be in good mood. And then second part, unhappy exits, or exits that you might not be that proud of because something went wrong. I think, Radu, you may start on that one.
Yeah. I think my first exit was the happiest one, being the first. I mean, the first is the first, and it's very interesting. So sold RAV antivirus security company to Microsoft. That was very interesting. That was back in 2002, 2003. Microsoft did not have a security business at that time, and all their security business, which is huge now, started with our team and with me personally, kind of starting their business there. Very interesting. It was Microsoft acquiring a mostly Linux antivirus that we were. Microsoft was under contract to give customer support for 3 years for Linux players. And at that time, Microsoft did not. And now there's Azure for Linux and so on. At that time, there is not. Very complicated contract to negotiate at that time. Much easier from the cap table perspective, which is our discussion. Those days, we did not have any VC nor other financial investors. So the company was, I was the vast majority owner of the company, and there was a significant ESOP. But ESOP, get the financial outcome and doesn't necessarily have a say into the deal itself. So very easy to negotiate from this perspective. So very happy exit from this perspective, and very interesting from the strategic perspective for all involved. Microsoft said that this exit was the best exit that they've had for the next 10 or 15 years, was teached in their M&A internal courses. and everybody on the seller side, so all the ESOP and the employees that were relocated to Redmond and everything, was happy that that happened. So that was the M&A advisor was happy, obviously. It was a hard work and amazingly good outcome for really everybody. So nobody really had to compromise on that.
Wow, it's a good one.
This is the perfect game of how you call it. Yeah.
Yep.
Well, I had two situations. To one extent, both having similarities, and then of course other differences. In both cases, the strategic investor wanted to invest or wanted to take over the company, and in both situations, it was part of the deal that the founders stay on board, keep some shares, and get their exit window or their exit opportunity later, based on a formula. So based on the value increase which has taken place between the first exit of the financial investors and then the final exit of the founders. And the tedious mechanics which then takes place is that the interests are not aligned anymore. So one thinks that one is totally aligned with the founders, all are pulling on the same rope, but at that point this is not the case anymore, because we as financial investors or as business angel in one situation wanted to get out and get a good return, whereas the founders wanted to optimize, of course, their package and their future exit, and in order to also not that the acquirer spends too much money now for paying out the financial investors, but keeping money for their exit. Yeah? And then it's a distribution game. Yeah? Who gets more out of the cake? And then it's exactly what Radu said. Yeah? Of course, the founder at the end of the day has the ultimate power, yeah, because he drives the car. Yeah? And if he says, sorry, guys, I don't like it anymore, yeah, then you have a severe problem. So as an investor, even if you're sitting on the co-pilot seat, yeah, it's very dangerous to take over the wheel. Yeah? So these were, at the end of the day, it worked out okay for all sides. Yeah. I have to say, in both cases, the final exits have not been that successful. So in both situations, we were lucky that we were off with a reasonable multiple at that point. Yeah. As I said before, one must not be too greedy in such a situation. Yeah. And prefer the bird in the hands than the birds on the roof. Yeah. And do it reasonably, not dream from any future opportunities, because many things must be true that they become life.
And I got to comment something here. From what I'm seeing, more and more, to the tune that these days I'm seeing 90% of the exits into this particular setup. So strategic acquirers and even PEs are actually acquiring now everybody, and the founders, or sometimes they even want the investors to follow the earnout route. So the acquirers are more and more scared about not knowing what they are getting, and basically saying, okay, we set this formula and I'm paying you $10 now, and then 10 times EBITDA, the first year, and 100 times EBITDA, whatever the numbers might be. And the founders are founders. The founders are optimistic. They only believe that things are going to go great and so on. And they're saying, yes. They put, their own bullshit P&L futures. They put it into the formula. They say, man, I'm going to get rich in the next 5 years. And
then comes the moment of truth. Yeah,
exactly.
Yeah. I think in any case, and probably Ronald, then it's good time to hand over to the shared audience and see if there are any questions. But what I would really write everybody in this school book is be aware that every capital increase, every financing round which you do on the journey on the road to an exit already is a trial exit. Yeah, and don't underestimate, given this series, that these kind of processes are extremely brutal. I recently had a capital increase for the round was not larger than 6 million for a startup which was pre-rev, means pre-revenue. Believe it or not, we did have 11 lawyers on the table from the acquirer, from the side of the investor stepping. 11 lawyers who are doing 3 months nothing else than going through the whole data room and turning every page, every letter, every sentence from backside to forward. And so this is extremely brutal. And this is, in my opinion, or in my experience, becoming worse and worse. Because we live in a world where nobody takes responsibility. Everybody wants to cover his or her ass. And so do the lawyers. The lawyers make a big business out of that. And of course, a data room of a startup is never perfect. Yeah, you have some flaws. It's as is. Yeah, you can only try to be as prepared as possible, and that's what I meant. Every capital increase before is a trial exit, because in every capital, in every round, you do have this process in a smaller form. So be careful, be precise, be comprehensive in documenting everything what is important in the data rooms. Yeah, archive your documents in the right way. Otherwise, the exit will become a nightmare or even not work out because the diligence fails.
Oh man, we need to speak at some point in time in a different podcast about reps and warranties. that would be a funny discussion.
That's true. Yeah.
Agreed. Thanks for the cue, Wolfgang. I guess we open the floor to the attendants. Please use the Q&A section of Zoom here if you have any questions to Radu or Wolfgang. Stage is yours now. And I hope I can see it here if somebody asks a question. So far, I don't see any, unless I'm wrong. Oh, I think so far we don't have any. Okay, then maybe we use the time and touch upon, we're talking about a bit of like the happy exits and also a bit of the sort of mediocre exit. But from your experience, Radu, it doesn't need to be an unhappy exit or something, but like something in hindsight you might have done differently in the course of one of your exits that might be interesting to hear.
I'm a stoic. I never go back and say, oh, I should have done something different. But there are unhappy exits. I mean, to start with, all the bankruptcies or all the write-offs are unhappy. You just write off investment. That's very unpleasant, and it happens more often than the good exits. So an investor has to be prepared to actually treat us to treat life as a statistical portfolio and actually look at the ensemble. If you put your heart and everything into, oh man, I lost my investment here because that was wrote off, that was wrote off, that was wrote off. At the end of the day, you may end up kind of crying after your life, right? And statistically, it works out well. So these are brutal. So wrote offs are brutal. I'm going to comment here a little bit on one clause. I believe that everything that we're speaking ends up in clauses, in contracts. And I think lawyers have seen so many things, and therefore they're trying to protect every case. And that's why the contracts are so long. So that specific clause says that the investor have a put option to the founder for $1 for all their ownership. And the founders that I'm seeing are like, oh, so you can actually oblige me to get your share for $1? Why is that? And basically that if the company is going down, your fund lifetime ends or whatever, for whatever reasons, you just want to unload the investment, to write off the investment. It's very complicated if you don't have such a tool. And actually, as an investment, the ability to unload the investment for $1, whatever, to the founder as an obligation for the founder, that's a very useful tool. Otherwise, it can be very unhappy that you are stuck with a zombie investment in your portfolio.
Okay. So in the meantime, we got quite some questions in the Q&A. The first one is, what's the perfect data room structure that should be in place in an M&A DD? Wolfgang, that is your question, obviously.
Yeah, the structure normally is defined by the acquirer's lawyer, who gives you a questionnaire and normally gives you the chapters. Small hints that I want to give you is on first hand. First, be careful that you can really document and prove the ownership of the different shares. So if you have a couple of capital increases, secondaries, some situation where one founder gave some shares to a co-founder, blah, 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 blah. All these are, unfortunately, in the GmbH structure, which we normally are in, things which cannot be totally proven. The better you have documented these transfers, the better it is in such a structure to make lawyers happy that they really know where they can buy from. Yeah, because the risk which they have is that they buy shares from somebody who doesn't own the shares. And this is, of course, a nightmare. Yeah, if somebody else comes here and says, it has been my share, so you have found the wrong seller. Yeah. Right. Second, in what you document for your operations, your business, be careful not to document too much, every detail, which also might pose questions. But confine your official minutes to the specific decisions be made, not the long discussions. Yeah, these are nothing which you should go into data rooms. So be very precise, complete, but concise in what you document. So that would be two hints most recently, which where I had the experiences my 11 lawyers, where most of the problems come from.
Thanks. Next question is, have you had a situation where VC wants to nudge a startup to start thinking about an exit via trade seller IPO for whatever reason, but at the same time, the startup does not want to initiate an exit because they believe they can scale significantly in the next 2 to 3 years? Anybody wants to?
Sure. This happens. What is normally? Normally, we bring a founder in contact with M&A advisors who know the markets, who have a feeling what can be positioned on the market, what cannot be positioned, and at least when we found startup founders to be absolutely open to just get in conversation with these kinds of M&A advisors. This doesn't mean that you already start an exit process, but you get informed. What is important? How are you seen from an advisor from the outside world? What would be potential requirements? And you also get normally honest feedback, because M&A advisors only take over a mandate if they're really sure that they can bring it to a success, because otherwise they won't earn money. Yeah. So that's why this is already a selection criteria. So you have to apply for getting a good advisor, and that's also a process. And we give our startups the advice that they should go into this qualification process and start early on to get in contact with M&A advisors and such to qualify for becoming represented very well. So it's not a big, at least in my experience, a big conflict here if you really drive it smoothly and reasonably.
Two comments here. One is that's very much like my wife is trying to convince me something that I don't agree. Is like she's like, oh, let's just think about it. Let's do one little step, and at the end of the day, I figure out that the contract is already signed, kind of thing. And second, I've been in a position exactly opposite, where the founders told the VCs that we have to exit because the market is going to go bazookas. and the VCs had a different perspective of the market. And there was a huge fight that ended up with the founder getting off the table and say, look, guys, I don't believe in the market anymore. We have this huge opportunity to sell. You don't want to sell, you take the company and, go crazy with it. And that was very close to a fist fight, and the founder won. And it ended up being right eventually. So it happens, interestingly, both ways.
Yeah, there's a very interesting question. We cannot tackle all questions. I'm sorry for that. So that upfront, there's an interesting question, I think, that says, for business angels, retail, and small investors, should we extend our time expectations regarding exit, as we have been discussed the trend and we see as well, or should we explore more secondary options? In the end, capital allocation preservation is its important job also for the angel and small investors. I think I sort of commented on that point previously, in a sense that I said, I think the sort of first liquidity event being a secondary is the most underrated one, that a lot of, at least not that much experienced investors don't see that much, but curious to hear your views as well.
Okay.
Take secondaries into account. Yeah, this is the advice which I can give you. Yeah, and you also must the money might be better allocated and invested if you take the money, even a little bit less, yeah, than probably in a final exit, and put the money into another fresh investments where you have another leverage. Yeah, so you must also think in sequences. How long is the money bound? Yeah, and in what phases is the money really working? Means creating multiples, and where it's sleeping in order to wait for the exit. Yeah, so that's one has to take into account, but it's not a standard receipt. I think it depends on the situation.
And I guess comments here are, it's about IRR. For angel investments, it's about IRR because you can reinvest. For VCs, it's about multiple because you cannot reinvest. That's one comment. Second comment is that you need to follow the market, and if you're invested in the market that's going down, it's something. If you're at the bottom, it's something else, and kind of try to be on the upside of the markets with your investment. So I think it's a really complex answer and very specific to specific situations.
And I would add to that, coming from the more traditional finance angle now, do not underestimate your personal liquidity premium, because each year illiquidity does cost you something. Do not underestimate that. Yep. That's what I would add. Okay. A question that is addressing, I'm looking at, no, that's fine. We still have a couple of minutes. From an exit perspective, is it better to operate or be headquartered in the US or Europe? Are there more advantages in one place compared to the other?
I can take this. I don't think it's an actual choice. I mean, where your company is where your company is. I think that there's more money as customers, investors, acquirers in the US. So, philosophically, it's better to be in the US. But if you are an Austrian or Romania or Netherlands, whatever company, you cannot mimic or just create a Delaware shell and say, oh, we are now in the US. Substance is where you are. And that is very hard to actually completely pivot a company to the US. It's a 3 years process.
And the flips in the meanwhile are rather complicated and also costly. Yeah. So in the meanwhile, the countries became aware of these tricks, and the tax regulations are much more strict. So you
actually have to have the company, the headquarters, the CEO there. That's a 3 years process, very complicated, very risky, and everything. If you only create the shell, it doesn't make any difference.
Yeah.
There's a question personally addressed to Radu. Radu, do you recommend negotiating an exit without an earnout, even if it seems like the founder is leaving money on the table?
It's a very personal thing. Depends a lot. I'm doing consultancy, like investment banking work for a few founders, and it's about what founders want to do. So one founder that I advised wanted to actually stay with the company like forever. He was a one-time founder and said, oh, I want to join this huge corporate and be there forever. So that was a huge earnout, and it actually ended up being huge for him. But if you want to sell this company and next year start another one or whatever, or retire, I think it doesn't really make sense. So it's a very personal choice, not necessarily financial, but lifestyle more.
Yeah, and two aspects adding to that. One is try not to find yourself trapped in a continuous controlling exercise, because calculating earnouts and then trying to optimize earnouts by just shaping the numbers is an absolutely unproductive and tedious and also not really healthy activity. So if there is some uncertainty, I would go a different way. This is becoming more and more practical, is that you give a warrant for specific things. Yeah. So you are given the higher purchase price, but it's against a warrant, a business warrant. And for the business warrant, there are insurances in the meanwhile. So it's not the concept where you then have to pay back 3 years later when the warrant is heard or met or not met, but the insurance pays for that. So you get a third party who is evaluating the risk profile behind your warrants, and for that you as a seller pay an insurance premium, and then the insurance takes over. So you have very clear interfaces, a very clear purchase price. You have the money on your bank. You don't have the obligation to pay it back. And the remaining risk or the remaining uncertainty is taken over by insurance, which of course costs some money, but it's a very practical way in creating clear boundaries and not making an exit process to a process which goes over 4 years.
Also something that I've said before, I'm going to say it again. As an entrepreneur, when you sell, don't believe your own bullshit about the future. So that's very hard to think of, but that's the truth.
I think we have the perfect last question, looking at the time and knowing that Wolfgang has a hard cut. And that question is, what will make you run from a potential investment? I think it's a very good one.
Yeah.
Over-promising, over-self-confident founders who tell me the can walk on water story, and the name dropping, whom they know and what great contacts they have, and without substance behind. So my personal view is I prefer substance. I prefer honesty. I prefer strong personality. Yeah, you need not be only a yes sayer, but and of course have the own opinion and have a strong mind. But you must be honest as a founder or as a business angel, honest and trustful, and the chemistry must fit. Yeah.
From my side, I believe a messed up cap table, it's a non-tangible thing. If you have a disgruntled co-founder that now is somewhere else and doesn't really work, and they don't like each other, I mean that's a complete no from no.
Agreed.
It's a no touch.
Might also be family businesses.
Yep.
So sorry to say, but coupled founders, or even worse, which of course it seems to be rather unfair now, but of course it's a huge risk at the end of the day, specifically for a family. If you have a couple who found something and have children or have young children, if something goes wrong, the family gets into a problem, and the real problem, and as we know in the startup business, there is a high probability this takes place. So these are situations where we normally give the advice, please really reflect if this is the right setup, what you're going to do. Because venture is a high risk. Venture comes from adventure. It's an adventure at the end of the day. and not a easy ride. Yeah, easy Friday afternoon ride, a sunshine ride. Yeah.
This is the best last word I could have wished for, because that squares the circle how I started off explaining what venture means in my view. So this was brilliant. For me, this was very interesting. This was educational. This was fun. Wolfgang, thank you for taking the time. Appreciate it. Radu, appreciate it as well. And everybody for joining in. Although it was the 1st of August, we had quite a high attendance rate. Appreciate it. Even from the ones who might have dialed in from the beach. We appreciate it even more. Take care, everybody. Bye-bye.
Thank you. Take care.
Servus.